Hello and welcome to our discussion on understanding the financial statements. In this session we will try to get into the profitability analysis using the DuPont framework. The DuPont framework, when we say profitability, the profitability can be seen through variations of return on investment. Profitability may be profit generating ability, or profitability may be profit distributing ability, as reflected by return on equity or return on capital employed or return on total assets. We can pick up any of these variations of ROI to understand and undertake the profitability analysis. But in this example, we will pick up the return on equity, which is an indicator of profit distributing ability of the firm. So the DuPont analysis gives a framework for decomposing the return on equity. The DuPont analysis shows a method of decomposing or understanding the drivers of return on equity. The drivers of return on equity is a profitability, efficiency, or the leverage. And profitability, efficiency, and leverage are the result of the operating decisions, investment decisions, and financing decisions. In other words, the DuPont analysis will try to establish and show the relationship between the overall profitability of the firm as reflected by return on equity and its link between the financing decision, investment decisions, and operating decisions. But we need some indicators for this OD, ID, and FD. So the profitability is reflected by PAT by sales. Efficiency is reflected by sales by total assets, and leverage or financing decision is shown by the total assets by equity. Now we can see that PAT by equity is PAT by sales into sales by total assets into the total assets by equity. So total asset cancel, sales by sales cancel, so it is PAT by equity. Now let us take an example at this position to understand the decomposition of return on equity. For that we will pick up the financial statements of Apple, and the financial statements required for undertaking a DuPont analysis is the balance sheet and income statement. So you have the balance sheet and the income statement. So the return on equity is equal to, we know that return on equity is PAT by equity. So we can see that PAT is 37,000 million and equity is 123.5 million. So 29.9%, 35.5%, and 33.83% is the return on equity of Apple in 2013. So that means the investor, the shareholders, are getting a return of 29.9, approximately 30% of this return. And that is, it is necessary to understand how is this happening. How could Apple do that? In order to understand that, we would like to undertake a analysis of decomposition of this return on equity. And as we already mentioned, the decomposition is PAT by sales, sales by total assets, and total assets by equity. So now let me just pick up for 1 year. We can see that the PAT by sales, which shows the indication of profit and the revenue, is 21%. That means for every $1 you sell, so the company is earning 21%. And the sales by total assets shows how the company is using its assets. Is it over investing or under investing in asset? In other words, it will show whether for a given asset it has the reasonable amount of sales. But the reasonableness depends on the competitor and the past positions. And this one shows the leverage of the company. Is the company dependent more on equity or more on the long-term debts? So the DuPont analysis decomposes the return on equity just to get an, you multiply these three, you get 29.9%. So now from here, where will it go now? Now let us pick up each of these items, and then we can pick up and understand and further drill down to analyze the return on equity. So of these three, this PAT by sales, which is a reflection of profitability, which reflection of the operating efficiency of the company, let us analyze this further. So analysis of PAT by sales, which is a component of this particular overall ROI drivers. Now profit by sales is affected by the tax burden, or is affected by the interest burden, or is affected by the OPEX burden. That means the PAT depends on the tax, interest and operating efficiency. The tax burden, interest burden and OPEX burden can be examined by seeing PAT by PBT, PBT by PBIT and PBIT by sales. Let us see that the example of Apple. So we have these numbers here. So the tax burden, okay, so the tax burden, so we have taken this number now. We have taken this number now to understand, analyze further. So the tax burden is PAT by EBT. That means 75% of the profit before tax is actually becoming the profit after tax. That means on average the company is paying around 25 to 24% of the tax in the last 3 years. The interest burden, there is no interest burden in this case because the company has not paid any interest during this period. Interest is zero because the company has no leverage. Though there is a long-term debt in the last year, it's possible that they might have taken the interest at the fag end of the year. So there is no interest burden. Entire EBIT is equal to earning before tax. And operating burden or OPEX burden is quite high. That means 29% of the sales is EBIT. In other words, around 70% of the sales is operating expense. So there is a need to understand. So we picked up this one and we saw that there is a tax burden or interest burden or an operating burden. Now we can examine the operating burden. The company cannot do much with the tax burden, that is statutory in nature. Interest burden could have been managed or can be managed by managing the financing decision. But here they don't have loans except in the last year. And moreover, Apple depends on the equity financing more. So therefore, operating burden, understanding the operating burden becomes important. So let us analyze that. OPEX consists of cost of goods sold, research and development, operating expense, selling and general administration expenses and other. So which expense is responsible for so high expense. That means around 70% of the sales is going in the form of expenses. We can examine that. Around 70%, and over a period of time it has been increasing marginally. So if you drill down that, we can see that the cost of goods sold, which is actually a significant part of the cost of revenue, we have to examine what is this cost of revenue further. The cost of revenue is accounting for 62% of the sales. So if at all, if the company has to improve its profitability, maybe there is a need to understand and examine the composition of these, the cost of goods sold, and then take action accordingly. If necessary, prune down those expenses. So the DuPont analysis starts with a return on equity and gives us an indication, a framework to show how is this profitability as reflected by return on equity can be improved. At the first level, we try to classify the return on equity based on the profitability, the efficiency and leverage. Then we wanted to understand how is the profitability affected, the margins affected by the tax burden, or affected by interest burden, or affected by the operating expense burden. Tax is statutory in nature. Interest depends on the financing decision. So there is a need to understand the operating expense. And operating expenses can be COGS or R&D or other expenses, or maybe selling and distribution, depreciation. Depending on the situation, it is possible to drill down these expenses. So the DuPont analysis or the framework is a nice framework, is a very important and useful and meaningful framework which tries to establish the link between the balance sheet and income statement, and enables us to focus attention on the return on equity and tell us what are the drivers of this return on equity. Thank you very much.